Bill and Terry, I would like to sincerely thank you for choosing me to help you with your financial wealth management goals. I've helped to devise a financial plan that will help you to reach your long-term goals and get you in a better place currently, as well as set you up for your future. So let's start off by talking a little bit about your current financial situation. One of the biggest things that we look at whenever it comes to your current financial situation are your financial statements. You provided a lot of information to me that allowed me to look at those and figure out exactly where you are right now. So let's start off by talking a little bit about your balance sheet. In the balance sheet, we take assets and liabilities and look at where your assets compare to the liabilities that you have accumulated. Your assets include things such as your checking, mutual funds, your personal residence, your home, your vehicles, things like that. As of right now, your net worth, which is assets minus liabilities, is positive, and it's actually $92,942, which is, considering you are in the asset accumulation phase of your life right now, that's a good net worth to have, especially it being that positive. So that's definitely a positive aspect of your current financial situation. One thing that was of concern in your current financial situation was the credit card debt that you have accumulated. But we're going to look for ways that we can get that minimized and reduce some of the spending that we have been doing and find simple ways to fix that. So overall, you are in a good place financially as far as your balance sheet shows. The next thing we're going to take a look at is your insurance. And I know that you both provided information to me regarding your health insurance, life insurance policies, things like that. You did not note any homeowner's insurance, so we're going to go ahead and get that added in case that anything happens to your home down the road. We can get you prepared for the future and make sure that your home's value is optimized once you get ready to sell it. So let's take a look at your statement of income and expenses. So now we're comparing what you're spending versus what you're spending. What you're spending versus what you're saving. And a lot of that comes down to your investment accounts, things such as your mutual funds. You're going to take part of your salary, put that in your savings so that you can get prepared for what's to come down the road. I know you both mentioned to me that you would like to retire at age 65, and then you would like to move and downsize to a small house cabin in eastern Tennessee. Well, to do that and make that possible, we're going to have to get everything paid off right now, between now and retirement, in order to make that an easier transition for you. So as of right now, your net discretionary cash flows, which would be the income minus expenses, comes out to a positive $2,000, which is good. You don't want to be in the negatives, and that shows that you do have a little bit of wiggle room as far as what area you choose to save, which areas you choose to spend, and you can find easier ways to maximize your savings to reach the goals you want to. So, with that being said, one recommendation that I would make to you to reaching your long-term goals is to create an emergency fund. As of right now, your emergency fund is pretty much non-existent. You do have over $9,800 in checking, which is a good thing. But really, considering it takes you around $5,000 a month in living expenses, the cost, basically your cost of living, is around $5,000 a month. We need minimally about $15,000 in savings in order to make sure that if anything were to happen, you were to lose your job, things like that, you have that as a backup. So what we're going to do to reach that goal and try to get $15,000, in liquidity available, is we are going to take out some of your living expenses. We're going to limit your discretionary living expenses, which are things such as entertainment, recreation, satellite TV, etc. I know those are going to be things you're not going to want to take out, but you can limit a lot just through, eating at home more, things like that. Such as cutting down on recreation expenses, travel right now, even things like gas expenses. We could take cheaper transportation for a while. And we're not going to drastically, of course, change anything, but I do think that simple changes will result in big results down the road. So that's our first step, our first recommendation we're going to make based on everything we've looked at. Although you do have a positive net worth and a positive net discretionary cash flow, we're going to go ahead and get that emergency savings boosted up. So in case something were to happen down the road, you will be easily and better prepared for it. So as far as your savings goes in your retirement investment funds, both of you are engaged in mutual funds. Teri does take advantage of the matching benefits that ASU offers. And Bill, I noticed that you do not take advantage of the matching opportunities that the credit union provides you. I would strongly recommend you to consider taking advantage of those benefits, because that could potentially be an extra 40 or extra 4% at the end of a year's time of your salary, meaning that would come out to around $4,000, which could be, pretty beneficial down the road. As I mentioned before, your emergency fund ratio, right now you're sitting at about 2 months of safety. So let's get that increased however we can. Your debt to total assets ratio is slightly high, coming in at about 7.7, and higher than 0.6 is kind of frowned upon. But we have to consider that you are in the asset accumulation phase right now. And what that means is at this point in your life, you're still working to accumulate assets, accumulate income before you get to that retirement point. So that's okay. If it's, it's a little higher than it probably should be, but over time, your debt is going to diminish as you pay more and more on it. So this is likely to decrease, in just a couple of years' time, the more you pay your debt down. So as far as your current financial situation, everything is looking pretty good, in the exception of the credit card debt, which I think can be monitored through spending less and trying to get more of that paid down. And we're going to shoot for paying around 30% of your credit card utilization yearly, and that's not including interest, but we'll get that paid down the road. As mentioned before, I know you talked about your long-term goals, and mainly your goals in general are long-term. And I have that all here in my discretion that I've been analyzing and looking at, and some additional ways that we can reach those that we have not previously discussed. So first off, you want to retire at 65. So if you retire at 65, this gives you 18 years left of working before you reach retirement age, because you're both now at 47 years of age. What we did was we took the net present value of, I'm trying to explain this in an easy to understand way. We took your net present value of today's dollars, your annual needs in today's dollars of living, surviving, thriving retirement. And then we took your retirement calculation, which means what your needs will be once you reach retirement. And that came out to about, well, let me break it down a little further. As far as the savings that you are going to need per year to reach your retirement goals, you are going to need to save $21,942 per year between now and retirement age in order to retire when you want to, live comfortably, and make things cash flow, make it work. So you're doing a really good job right now of saving. Right now your savings are currently over $21,000, about $21,400. So we just have a few modifications that we need to make in order to reach that goal. We'll add on an extra $600 or so per year into your investment funds, and that way you have a little bit of cushion and you're reaching your goals exactly where they need to be at the end of a year's time. In addition to that, I know that you mentioned that down the road you plan on downsizing and moving. So once you reach retirement age, you can sell your house, and once you do that, then you can look into purchasing the house in Tennessee. So basically, by looking at the future value of your home based on the predicted inflation in 18 years, your house will be worth significantly more, around $272,000, meaning that if you are able to sell your home for that price, and then you can take that money and purchase a house in eastern Tennessee, a small cabin as you mentioned, and we predicted that it would take around $100,000 to do that. So basically, you would be selling your house for $272,000. then purchasing the home in Tennessee for around $100,000. Well, that leaves you with a pretty good net profit off of that. And that is assuming that you keep making your payments on your current home in Jonesboro, keep making your payments, and get the entire house paid off, which should take less than 12 years. So that should give you plenty of time between now and retirement to get your house paid off. Once you get it paid off, you know, you've got just 6 or 7 more years of work, and then you can look into that downsizing after retirement. So basically, once you choose and get that done, you can sell your house in Jonesboro, move to Eastern Tennessee, you've got your retirement savings all there, everything's looking good, then you could possibly be left with $150,000 to $170,000 that you've made as a profit off of your home by downsizing and moving to Eastern Tennessee in that cabin. So what are you going to do with the extra money? Well, I know you had a few additional long-term goals that you mentioned. Bill wanted to make sure that Teri was taken care of in case something does happen to him. Bill, you might choose to take some of that money, take some of that $150,000, put it in some sort of savings account, put it in a fund specifically for Teri in case that something were to happen to you, to make sure she has some additional cushion. Another thing, you did mention wanting to do the endowment for the Arkansas State University Student Travel Scholarship. This is a perfect opportunity. If you wanted to start saving now and putting some back, you can. If you're not at the point where you can do that in 2019, you might want to wait until 2036 to start doing it, especially if you're able to sell an asset for this kind of price, make this profit, take $25,000 of that or however much you wish to endow, put it in a fund, put that in your will. That way, upon your death, that they'll know exactly what to do with that money. They will know that $25,000 in this account is to go to a scholarship at Arkansas State University for a travel scholarship endowment. And like I said, you might want to start saving now earlier and have that ready, but this would be a perfect opportunity to take some additional funds to put towards that endowment if you wish. Also, I know that you mentioned that you do not have a will. I would strongly recommend that you get that will developed, because in the case that something happens to both of you and the other beneficiary is not able to do that, then that will go into the state's hands. The state will decide what to do with your estate. So I would strongly recommend that you do that soon. Get your will set out, look into it a little further, and figure out exactly what you want to happen with money that you've worked so hard for all your life. So, taking a step forward back to the current situation, the recommendations can be broke down to this. Number one, need an emergency fund. We're going to work to get that fit in your yearly savings, get an emergency fund going. You've got $9,800 in your account right now. If you keep around that amount of money in your account, you could designate it specifically to an emergency fund, but either way, it is liquidity. Then we're going to need about $5,200 more to reach the maximum liquidity for 3 months of living. So if it costs you $4,900 to $5,000 to live per month, we need right at $15,000 in liquidity. So we're going to work this upcoming year to do that. In addition to that, we are going to increase savings, of course, to the required yearly funding. So we're adding on an additional $600 or $700 of savings in order to reach the maximum amount of savings required for you to live comfortably in your retirement, the required amount that you need to live in your retirement age. And as I mentioned before, we're also going to work on getting you some homeowners insurance. We want to make sure that that big asset, your home, is taken care of in the case of a natural disaster, flooding, anything like that, an emergency. We're going to make sure that your home is covered. The homeowner's insurance is going to cost you around $1,300 per year. In Arkansas, it is a little higher than the average, but we want to make sure that you're taken care of. In addition to that, let's go in a little bit in specifics. So your total savings, including the emergency fund, is going to increase from $21,400 to $27,186. That's a slight modification, and we are going to do that through limiting your living expenses a little bit. In the initial estimate, you did not provide me your specific living expenses, so I calculated an estimate based on 40% of your salary. It needs to be 50% or less, so we went with 40, and we estimated after this increased savings, in order to have your emergency fund and reach your long-term goals for retirement, we decided to limit the living expenses to 36%. And that's totally modified. You can modify that in any way that you prefer, of course. But that came down from over $66,000 to $61,000 that we can take elsewhere. So, in conclusion, I have a written plan available for you that you can take a look at and has some further guidance and recommendations. It kind of breaks everything down, where you are currently, what your goals are, some recommendations that I have on how you can reach those goals. And I encourage you to reach out if you have any questions at all. I would love to help you any way you can. You have did a wonderful job taking care of your estate. We will do anything that we can to help you. And I wish you the best of luck and have a great day.